We've all heard the familiar story about real estate. Interest rates were too low, people became over leveraged as a result of all the cheap money, bought a bunch of real estate, and then interest rates went higher than people were expecting. That meant they could no longer afford the future payments. But they also couldn't afford to liquidate their property because if they did, they wouldn't have enough left over to even pay off their loan. Their only option at that point was to default, which means that the banks, who had also become overexposed to these real estate loans, were at risk of failure for having too many of these loans default. Now, you might think that I'm describing to you the great financial crisis. However, what I'm describing is what's going on right now, but it's not what you think. I am not describing something that's happening right now with residential real estate, with people's primary residences, the homes that they live in. There is no crisis there right now. However, this crisis is in commercial real estate, where big money made big mistakes, and commercial real estate may very well be the next thing that takes down the US banking system. In order to understand how and why, we need to take a look at what happened last time to understand what's happening right now. Back in the early 2000s, when the dot-com bubble burst, Greenspan invented the Fed put and started lowering interest rates to deal with the fallout in the economy. And logically, as interest rates moved lower, that meant mortgages became cheaper. And so the lower interest rates fueled a housing bubble as people were able to afford more house for the same monthly payment. But it wasn't just the lower interest rates. It also had to do with something called an adjustable rate mortgage. Now, most people are very familiar with adjustable rate mortgages, but if you're not, it basically is a mortgage that for now, the interest rate is a lot lower than what you could get with a regular fixed 15 or 30-year mortgage. And in trade-off for that, that means that in 5 years, 7 years, 10 years, when the interest rate adjusts, it'll just adjust up to whatever the market rate is at that time. So 20 years ago, people got sucked into these adjustable rate mortgages because it meant they could afford even more of a house, because they could afford that monthly house payment for those first couple of years. And they didn't think that interest rates would be much higher in the future because house prices were going up, the economy seemed great, and so they just thought, hey, if I can't afford the mortgage when this thing resets, when the mortgage adjusts higher, then I'll just sell the house for more than what I'm buying it for right now, or I'll refinance to a 30-year mortgage at that time. And so the nation gorged itself on cheap real estate through cheap loans, and eventually a giant pile of adjustable rate mortgages piled up. And when it all started to adjust, that meant that people couldn't buy anymore. People couldn't afford what their current mortgages, their current house payments were adjusting to, and so they started to become sellers instead of buyers. When all the buyers turn into sellers, that means the prices stop going up, which means that people stopped having the option to just sell to get out. And if they can't sell to get out from that payment, and the payment adjusts upwards, and they can't afford that higher payment, the only option left is to default. And of course, the banks had over-leveraged themselves as well and had gorged themselves on these mortgage-backed securities and held a ton of these assets that they thought were going to be moneymakers. And it turned out defaults started rolling in, and those assets they thought were worth a lot were actually worth very little. And it started to knock over the banking system until the Federal Reserve and the government stepped in to bail it out. I need to be very clear here. This is not happening today with residential real estate. The situation is very different than it was 15 to 20 years ago. Number one, vast majority, about 80% of mortgages are 30-year fixed mortgages, not adjustable rate mortgages today. Number two, a large percentage of Americans actually own their homes free and clear with no debt. In fact, over 38% of owner-occupied houses are owned with no mortgage. Number three, most homeowners were able to refinance during 2020 and 2021. This means that any homeowners who were able to purchase a home before 2021 were able to lock in a mortgage rate well under 3.5% or 4%, some even around 2.5%. This means for the vast majority of homeowners, it is way cheaper to stay where they are rather than move to a new house with a new mortgage or to a place to rent, which means most homeowners cannot afford afford to sell their current home. And finally, credit standards for the last 10 years have been much tighter than they were leading up to the great financial crisis, meaning that the people who were qualifying for mortgages had higher incomes and higher credit scores. However, we are seeing history repeat itself, this time with commercial real estate instead of residential real estate. And it's the exact same story. In short, just like last time, we got a load up of leverage during extremely low interest rates. Interest rates have skyrocketed higher, which means that property values have stopped going up because you need debt to be able to afford these large properties, and the debt got more expensive. That means for these properties, they can't be unloaded and sold because there's not enough value there to pay off the loan. But these loans are adjusting or they are maturing, which means that these property owners also can't afford to refinance or to keep the property because the property doesn't pay enough, because the property doesn't make enough to pay those new bills. So since refinancing and selling are not options, the only option left is defaults, which as they roll in are threatening the stability of the US banking system. Again, I'm going to explain this in detail, how this happened and why commercial real estate this time is putting banks at failure. But if I'm right about this, it means that commercial real estate has much lower to go. I am currently short Vanguard's real estate ETF, VNQ, through the use of an option strategy called a credit call spread. This is a particular strategy that the maximum potential loss is 50 cents and the maximum potential gain is $4.50. And so if you were to trade this strategy with 5 contracts, you'd be risking $500 to make a potential $4,500. And if you would like to learn how to trade option strategies like this that allow you to profit on any market conditions, whether it's volatility, a move downwards, a lack of volatility, you need my options mastery course linked in the description below. I'll be the first to admit this program is long. It will take some effort. It will take some time. It is complex, but it will work better than anything you've ever tried. And included in my options mastery course for a limited time is a one-on-one coaching call with me. Check it out, link is in the description. Over the last 5 to 10 years, commercial real estate has chugged along at a fairly consistent pace. But this $20 trillion market is starting to crack and maybe putting our banks at risk right now. When people are looking at stocks, they're typically looking at the PE ratio. If you want to know what the stock is worth, that's really the first ratio you're going to look at, is the price to earnings ratio. With commercial property, you're going to be looking at something called a cap rate. The cap rate is very simply the property's net operating income divided by the current market value. Basically, how much income does the property produce for you as a percentage of the property's price? So when interest rates on loans are really low, you can afford low cap rate properties and you can finance a large percentage of the property. For example, let's say you're going to buy a commercial property that'll produce for you $100,000 per year. You're probably not going to take out enough debt on that property to where your loan payments are going to be $100,000 a year. Then you don't have anything left over for any other expenses or for profit. But you might take out enough of a loan so that your loan payment is $30,000, $40,000, $50,000. Now, depending on where interest rates are, that payment might mean that you have financed a large percentage of your property or a small percentage of your property. It also means that the higher interest rates go, the smaller of a loan you're able to afford on your property. Otherwise, you just have to pay for the rest of the property in cash. Putting the math to the side, basically it means just like in residential real estate, if interest rates are really low, you can afford a much higher purchase price because the monthly payment is smaller. But there's a key difference between residential loans like 30-year mortgages and commercial property loans. Typically with commercial real estate, these are 5, 7, 10-year loans that have a balloon payment at the end. So for the first 5, 7, 10 years, they're basically sometimes interest only or they're very small payments. And then at the end of the 5, 7, 10 years, you owe the entire loan back. And for the last decade or so, this has been fine because when that balloon payment comes due, you've spent the last couple of years increasing rents. You've been making different changes to the property. You've been getting different tenants in your property. And so you've been able to increase the value of the property, increase increase the rents. And so you're either going to refinance with a new loan that has a new balloon payment in 5, 7, 10 years, or you're just going to sell the property for much more than what you originally borrowed to purchase it. But obviously the last couple of years have been very different. A few years ago, rates were extremely low, rock bottom low, and now they are screaming higher. This means that property values are not worth more than they were a couple of years ago, especially commercial real estate. Now, obviously there are many different types of commercial real estate. You've got shopping centers, you've got office space, you've got hospitals, you've got large residential apartment buildings. And so we can't lump all this together in the same basket. But if we do lump it together in the same basket, on average, commercial property values are declining quickly. In fact, they've fallen the most since 2009. This means that for many commercial property owners, they're in a position right now where if they try and sell the property, they're not able to sell it for as much as what they owe on the property. It also means that they can't afford to refinance their loan and pay off their old loan, which are starting to mature this year, with a new loan, because the property only creates, let's say, $100,000 worth of income, but the new loan at the new much higher interest rates, now the Fed has been raising rates at faster pace than anyone expected, would mean that their new loan payments would be more than the $100,000 that property produces. So they can't afford to sell and they can't afford to refinance. And when you can't afford to do either one of those, the only option left is to default. And when the only option left is to default, it makes sense that commercial mortgage bond sales have been dropping, and this last year dropped by a staggering 85%. Now you might be thinking, well, this is bigger money. Maybe it's not the biggest money out there, but this certainly isn't the dumb retail investor who back in 2005 loaded up on a few rental properties and they were just empty, hoping to sell them the next year for $200,000 more each. These are accredited investors. These are companies. These are high net worth individuals. These are people that should know what they're doing. And certainly the banks making these loans wouldn't have overgorged themselves on these loans again, right? Well, unfortunately, during 2021 and especially 2022, it looks like that is exactly what happened, that banks loaded up and gorged themselves on commercial real estate loans. During 2022, they increased by 11.2%. That was the most since 2006. Not only that, but commercial real estate loans make up almost a quarter of all bank loans. And yes, tightening lending standards have started to increase across the board for commercial real estate loans. But that's not going to do anything to their massive book of commercial real estate loans that they already have that are starting to see defaults roll in. All that's going to do is make it harder for all the existing properties to roll over their debt into a new loan, which exacerbates the problem, doesn't make it better. Add on top of this the fact that the last couple of years have drastically and quickly changed the commercial real estate market, especially for things like office space, with everybody wanting to work from home, and it looks like at least partly that trend is here to stay, with more online shopping taking the place of needing storefronts for many businesses. And the worst part is for this that most of the banks that are exposed or overexposed are small regional banks, where these investors, these owners, and these companies have relationships with these small regional sized banks in order to continue doing these loans for their business, for their investments, and it's a long-standing relationship. But given, number one, the fact that many people with large amounts of money, anything over $250,000, are now concerned about leaving their money in small regional banks where they don't have tech companies, so they're not too big to fail. They want to move their money to the big banks, and they can't, because if they do, now they can't do their lending with that bank anymore. But also it means that a lot of these banks are actually at risk of failure because they have so much exposure to these commercial real estate loans, and the defaults are starting to roll in. And so the banks that are most vulnerable to a crash in commercial real estate are the ones that are also most vulnerable of having depositors flee. Not a good mix if you're a bank worried about staying in business. At his last press conference, Powell said that he is not concerned at all about the commercial real estate crisis right now affecting banks and bank solvency and the soundness of the banking system across the states, which means that more likely than not, it is the biggest thing to worry about right now. As always, really appreciate you guys. Thanks so much for watching. Have a great day.